Welcome to Breaking News to Trading Moves. Welcome to The Debate. Imagine sitting at a computer, just pressing random keyboard buttons that do absolutely nothing, yet being completely convinced you are controlling the stock market.
Right. I mean, it sounds completely absurd.
It does, but some of the highest paid professionals in London did exactly that, and it cost them tens of thousands of pounds. So today we are exploring overconfidence, the illusion of control, and how these cognitive phenomena dictate investment decision-making.
Yeah. Specifically, we are looking at why traders engage in destructive behavior, things like overtrading and holding on to losing positions. And it is a crucial conversation because it gets to the heart of how human beings process probability and risk.
Exactly. So our core dividing line today is this. I look at the data and I see this destructive behavior as primarily an intrinsic, trait-based psychological characteristic. It is an internal flaw in how specific individuals process their own ego and probability.
And I contend that this behavior is a situational response engineered by the highly uncertain, noisy environment of financial markets. I argue it is an external trap that forces individuals to adopt the illusion of control purely as a coping mechanism.
To frame it in a single sentence, I represent the view that overconfidence is a fixed individual trait, while you represent the view that overconfidence is a market-induced environmental reaction.
Precisely. The market makes the trader, not the other way around.
Well, let me elaborate on why I see this as a measurable dispositional trait. When you analyze long-term trading performance, the failure to detach from outcomes is a structural limitation of the individual trader's ego. The data demonstrates that a trader's inherent propensity for the illusion of control correlates directly with lower trading performance and lower remuneration. And we see demographic data showing that inherent biological or socialized characteristics map directly to overtrading. So it is not the market doing this to the trader, it is the trader bringing their inherent psychological wiring into the market.
Right, but I come at it from a different way. The trading environment itself manufactures this behavior. Research in cognitive psychology shows us that the human brain naturally seeks certainty to avoid psychological discomfort.
Sure, but
Let me just finish this thought. Market conditions are characterized by abundant information, public disclosures, and highly ambiguous feedback. These environmental elements trigger confirmation bias and overconfidence even in the most rigorously disciplined individuals. So overtrading is not a personality defect. It is a temporary psychological coping mechanism induced by stillness in a volatile market. The market demands waiting, but, the human brain simply cannot tolerate that void.
I see why you think that. But let me give you a different perspective using concrete data. Let's examine a study involving 107 investment bank traders in the City of London.
Okay.
These are highly compensated professionals, not amateurs. The researchers had them engage in a computer task with entirely random outcomes. They were asked to raise an index on a screen using specific keyboard keys.
Wait, just to make sure I am following you, the keys they were pressing were completely disconnected from the chart? Like they had literally zero effect on the line they were watching?
Zero effect. It was a pre-programmed random walk. It was a pure measure of their illusion of control. The researchers wanted to see who would associate their random clicks with the chart randomly moving upward.
Wow. And the results were stark, right?
Very. Traders who exhibited higher trait-level illusions of control, meaning they genuinely believed their random typing was driving the chart, earned considerably less money in their actual jobs.
The drop in remuneration was quite severe, as I recall.
Extremely severe. Think about this. A mere 1 standard deviation increase in this illusion of control was associated with a £58,000 decrease in total annual remuneration.
That is a lot of money to lose to ego.
Exactly. Their ego was directly taxing their bank account. And their managers also rated them noticeably lower in risk management and analytical ability. If this behavior was purely environmental, all these traders sitting on the exact same floor looking at the exact same screens would exhibit the same behavior, but they don't.
But how does that translate to actual trading? I mean, typing on a fake keyboard isn't a live market.
Think of elite traders like the house in a casino. The house trusts a statistical edge over thousands of spins without emotional attachment to any single outcome.
Right.
Those who fail possess a hardwired psychological need to be right on every single spin. How can we blame the environment when individuals in the exact same environment yield such wildly varied, trait-dependent results?
I'm sorry, but I just don't buy that. Let me tell you why. You have to look at the very nature of that trading floor in London. What are the environmental characteristics?
Well, they're stressful, obviously.
Intense stress, hypercompetition, high workloads, and incredibly noisy feedback. You cannot isolate a behavioral trait from the pressure cooker it exists within. When human beings are deprived of opportunities for actual effective action, which happens constantly in trading, where price changes are essentially random, they actively try to restore control cognitively.
But they are inventing control where none exists. The chart was entirely random.
Because the environment demands action. Let's use the elevator button analogy. When you are standing in a lobby waiting for an elevator, pressing the button repeatedly doesn't make the elevator arrive faster.
No, it doesn't.
People do it anyway. Why? Because it provides a momentary illusion of control in a situation where they have absolutely none. Traders click buttons, enter trades, and tweak orders because they are profoundly uncomfortable with stillness. The market deprives them of agency, so they invent agency.
I have to admit, I struggle to accept that the environment is the sole puppet master here, when the reactions are so disparate. Yes, everyone presses the elevator button once.
Right.
But the person who presses it 50 times in a row, sweating and swearing, has a dispositional difference from the person who presses it once and calmly waits. The London study showed that individuals with a high propensity for illusory control beliefs are simply less effective at analyzing markets. They deny the lack of control.
I'd argue that stubbornness is a learned coping strategy, not a genetic mandate. People use denial and retreat into self-protective illusions when they face discrepancies they cannot resolve.
But if the environment is the main driver, how do you explain the massive gap in who actually falls for the trap? Let's look at the Barbara and Odine demographic data on household brokerage accounts.
Okay, let's look at it.
This isn't just a handful of day traders. This is exhaustive data across tens of thousands of households. The numbers show men trade 45% more than women, and the contrast is starkest among single individuals. Single men trade 67% more than single women.
Wait, 67% more? Just to clear that up for the listener, that high activity level doesn't mean they are yielding higher returns, right?
Exactly the opposite, actually. The constant buying and selling racks up transaction fees, like crossing the bid-ask spread and paying commissions. That excessive activity directly degrades their net returns.
I see.
They are all interacting with the exact same stock market. They all face the identical environmental ambiguity you described. Yet, biological and demographic variables dictate the level of overconfidence and the illusion of action. Single men are taking the exact same environment and extracting a completely different, much more destructive behavioral response than single women. This proves that inherent traits are the primary drivers.
That is a compelling argument, but have you considered that the underlying mechanism causing those demographic differences relies entirely on environmental ambiguity to activate?
What do you mean by activate?
Well, psychological research demonstrates that gender differences in self-confidence depend heavily on the lack of clear, unambiguous feedback. When feedback is clear, immediate, and unequivocal, men and women show very similar levels of confidence regarding their abilities.
Okay, but the market isn't clear.
Exactly. The stock market is the ultimate ambiguous environment. You can make a terrible choice and still make money if the market rallies, or make a brilliant choice and lose money due to a macro event.
So you were saying the market acts as a catalyst, but you still acknowledge the trait difference exists.
I'm saying the ambiguity acts as a magnifying glass for societal conditioning. Without the environmental trigger of unclear feedback, those demographic differences would remain largely dormant.
I'm not sure I agree it's just dormant without the market.
Look at how traders successfully correct this behavior. We know from the literature that 95% of all trading mistakes are emotional. If overtrading were a fixed, immutable trait, then behavioral interventions would be useless.
They often are, for certain traders.
But practical tools like the 15-minute cooldown rule, where a trader strictly steps away from the screen after closing a position, are highly effective. Or the deserve to risk checklist, which forces a trader to verify structure before execution. These tools work precisely because they address an acute environmental reaction. You cannot fix a permanent personality trait with a 50-minute timeout.
I'm not convinced by that line of reasoning because you're confusing the management of a trait with the eradication of it. A checklist doesn't cure an ego-driven need to be right. It merely provides a mechanical guardrail.
A guardrail against the environment.
The reason single men need that guardrail 67% more often than single women is due to disposition. The biggest enemy is not the market. It is the fear, hesitation, and emotional baggage the trader brings to the trade. A trader who operates with the illusion that they need to be right is suffering from an internal defect in how they view probability.
I would argue the market absolutely cultivates the ego, especially when we talk about how information is processed and distributed. You claim the trader brings the baggage, but the market provides the exact type of baggage guaranteed to weigh them down.
Let's examine that information processing, because we need to move from who is trading to what they are trading on. Confirmation bias and overtrading stem directly from the internal ego protecting its belief system.
By filtering data, you mean?
Yes, we have to look at cognitive dissonance. For those unfamiliar, cognitive dissonance is the intense mental pain that occurs when reality contradicts your closely held beliefs.
Right.
To resolve this pain, a trader with a fragile, overconfident ego will actively seek out information that aligns with their existing positions. They literally filter reality to protect their self-image.
But the volume of information is what forces that filtering process.
It plays a role, but the response is internal. This stubbornness leads to revenge trading, where a trader takes a loss, gets emotional, and tries to force the market to give the money back. It also leads to the disposition effect.
Which is holding on to losers, right?
Exactly. The tendency for investors to hold on to underperforming assets for extended periods because selling them would require the ego to admit defeat, while on the flip side, selling winning assets too early just to secure a quick ego boost. The information proving they are wrong is readily available, but the internal trait prevents the trader from processing it objectively.
The structure of modern information distribution is the true catalyst here, not the fragility of the ego. Let's look at the literature on how investors process public disclosures.
All right.
Overconfidence spikes severely after public disclosures. Why? When an investor holds exclusive private insight, they feel secure. Their brain feels they have a structural edge.
Sure, they have an advantage.
But the moment that news goes public, the brain panics because its edge is gone, prompting an adrenaline-fueled overreaction to regain control. Investors lean far too heavily on their previously exclusive insights when news goes public. They react excessively to both good and bad news.
But why do they overcompensate? That implies an internal mechanism.
Because confirmation bias becomes more pronounced simply due to information abundance. We see this vividly with different investment styles. Research shows that value investors, who typically look for underpriced assets, react strongly to bad news while barely registering good news.
And growth investors do the opposite.
Precisely. Investors in glamour stocks, high-growth, popular companies, overrate positive news and slowly react to negative developments. The market structure blasts abundant, conflicting data at participants every millisecond. When you have too much data, the human brain has to filter it, and it naturally defaults to whatever confirms its current trajectory just to survive the sheer volume of input.
That abundance of data is exactly why trait-level discipline is paramount. You are describing a situation where the environment tests the individual. The market tests everyone, but only those with high trait overconfidence fail the test so spectacularly.
I wouldn't say spectacularly.
Well, let's talk about how the market actually rewards participants. Trading outcomes follow a harsh Pareto distribution.
Let's break that down for the listener.
Right. A Pareto distribution means that a tiny fraction, maybe 10 or 20% of traders, are pulling out almost all the profits, while the vast majority are getting crushed.
True.
If the environment dictates the response uniformly, outcomes would be much more evenly distributed. But they aren't. The winners are not immune to the flashing lights. They simply possess a different psychological makeup. They possess the rare ability to detach. They view trades as neutral, just numbers on a screen without emotional weight. That ability to think in probabilities rather than certainties is an individual cognitive skill, a trait, which the majority frankly lack.
That cognitive skill is often the result of surviving long enough to build rigorous environmental buffers. The so-called elite traders are not genetically immune to confirmation bias or the fear of missing out.
I'm not saying genetically immune.
They have simply adopted strict rules, like algorithmic execution, hard risk limits, or entirely removing themselves from the desk during certain hours. They succeed by recognizing that their environment is toxic to human psychology, so they build walls against it. They don't overcome the market with sheer force of personality. They construct a specialized environment around themselves to block out the noise.
But constructing that specialized environment requires a level of self-awareness and trait-level humility that overconfident individuals simply do not possess. The overconfident trader believes they don't need the 15-minute cooldown rule because they believe they are always rational and always in control.
Right.
Their internal flaw prevents the adoption of the very external buffers you're advocating for. It all comes back to the individual's inherent disposition.
We have spent quite a while analyzing the mechanics of this, and I think it is time we pull our perspectives together. From my standpoint, acknowledging the market's environmental triggers, extreme ambiguity, information overload, and the psychological discomfort of stillness is the most accurate way to understand and mitigate destructive trading patterns. Blaming the individual allows the financial industry to ignore how detrimental the trading environment truly is to human cognition.
And I maintain that identifying individual psychological traits, like an inherent propensity for the illusion of control and fixed ego barriers, is the most reliable predictor of trading performance and failure. If you ignore the individual's disposition, you are trying to treat the symptom without acknowledging the underlying condition.
Despite our differing angles, we clearly converge on the reality that overconfidence acts as a severe tax on financial capital.
Absolutely. The illusion of action, the belief that doing something is always better than doing nothing, is a primary threat to investors across the board.
Right. And moving forward, there is much more to explore within the literature regarding how institutions might actually buffer traders from this environmental stress. We need to look at how trading floors and digital platforms could be redesigned to promote deliberation rather than impulsive reaction.
There's a rich vein of research there, particularly in how we balance internal disposition with external market design when evaluating financial decision-making. We will leave it to the listeners to weigh these dynamics and form their own conclusions.
Definitely.
But it brings us back to how we frame this entire profession. When you sit at a trading terminal, you aren't flying a mechanical airplane where every input perfectly dictates the outcome. You are sitting in a simulator that is feeding you continuous turbulence, and your job is to realize that pulling the lever constantly won't stop the storm.
And that simulator has instruments that often lie to you.
A perfect way to describe it. Thank you for joining us on The Debate.